So you want to build a food delivery app, connect millions of hungry people with restaurants, take a cut of every order, and let the orders roll in automatically. Simple, right? On paper, it looks like one of the most scalable businesses ever invented. No kitchens to run, no inventory to buy, no restaurants to build. Just an app, a network of drivers, and a percentage taken from every transaction that flows through it. It feels like pure, infinitely repeatable profit, growing wider every time someone opens the app at 8 o'clock on a Friday night. But that's only the beginning. The real story starts after that. That's where the economics become interesting. Here's what most people completely miss. Despite billions of orders placed every year, food delivery apps have spent most of their existence losing money, sometimes staggering amounts of it, even while growing into household names recognized on every phone's home screen. Take DoorDash, now the largest food delivery company in the United States by market share. For years after its founding in 2013, the company operated at a loss, and even after going public in 2020, it continued reporting net losses in several subsequent years according to its own COE filings, despite processing tens of billions of dollars in orders annually. Uber Eats, one of its biggest rivals, spent years as a money-losing division inside Uber, before finally turning profitable on an adjusted basis. Years after Uber itself had already gone public. That sounds impossible. A business connecting hungry customers to hungry restaurants, and it can't turn a profit? Until you see the costs, it doesn't make sense. Once you do, it makes uncomfortable sense. Start with what the business actually sells. A food delivery app isn't really selling food. It's selling coordination. Timed across 3 separate parties who all want something different from the same 15-minute window. The customer wants speed and low prices, the restaurant wants orders without losing its own thin margin, and the driver wants to be paid fairly for their time and gas. The app sits in the middle, trying to satisfy all 3 simultaneously, and typically ends up disappointing at least one of them on any given order. This is exactly why the business looks so profitable from the outside looking in. Delivery apps typically charge restaurants a commission ranging from 15% to 30% per order. According to widely reported industry figures and multiple city-level fee caps enacted during the pandemic. On top of that, customers pay delivery fees, service fees, small order fees, and often a menu markup built directly into the prices shown inside the app, sometimes 10 to 20% higher than what the same item costs walking into the restaurant. Multiple revenue streams stacked on top of a single transaction, all extracted from one $25 order of pad thai. But here's what most people completely miss. Almost none of that stacked revenue is profit. Most of it is immediately consumed by the single largest cost in this entire business: paying the person who actually drives the food to your door. Delivery apps generally don't employ drivers as traditional staff with salaries and benefits. Instead, drivers work as independent contractors, paid per delivery, often with incentives layered on top for distance, wait time, and demand surges during dinner rushes or bad weather. This structure keeps labor flexible for the company, scaling up or down instantly without payroll obligations. But it also means the company is effectively paying, in aggregate, for gas, vehicle wear, and tier, insurance gaps that traditional employment would normally cover, and long stretches of unpaid time spent waiting at a restaurant counter for an order that isn't ready yet. None of this shows up as a clean single-line item on a spreadsheet, but all of it gets priced, indirectly, into what a driver ultimately needs to be paid per order to make the work worthwhile. That sounds manageable at first glance, until you see the costs stacking on top of each other, order after order, all day long. Consider a simple, realistic order. A customer buys $25 of food. The restaurant might pay the platform a commission of around 20%, roughly $5. The platform might also collect a few additional dollars in delivery and service fees charged directly to the customer. Combined, that might total $8 to $10 in gross revenue for the platform on that single transaction. Now subtract what actually goes to the driver. Many delivery platforms pay drivers a base rate plus incentives that frequently total more than what the platform collected from the restaurant commission alone, especially on short-distance, low-value orders placed during slow periods. Add in customer support costs, payment processing fees, insurance coverage, background check systems, app infrastructure, server costs, and marketing spent just to acquire that one customer in the first place, and the $8 to $10 in gross revenue can shrink to nearly nothing, or turn negative entirely, especially in markets where local regulations cap the commission a platform is legally permitted to charge restaurants. This is where almost everyone gets it wrong. They imagine each order as an isolated, self-contained unit of profit. In reality, the entire business depends on enormous volume and statistical averages, where some orders are barely profitable and others lose money outright. Particularly small orders placed during off-peak hours in low-density suburban areas, where a driver might wait 20 minutes inside a nearly empty restaurant for a delivery fee that barely covers their gas money home. And this changes everything because it means growth alone doesn't guarantee profit in this business. It can just as easily guarantee bigger losses at a bigger scale, multiplying an unprofitable unit economics problem across millions of orders instead of fixing it. This is exactly what happened across the food delivery industry during its rapid expansion years. Roughly 2015 through 2021, Uber Eats, DoorDash, Grubhub, and countless smaller regional competitors spent enormous amounts of venture capital on driver incentives and promotional discounts to win market share as quickly as possible, essentially subsidizing artificially cheap delivery out of investor money rather than actual operating profit. Venture capital firms poured billions of dollars into this race, betting that whoever captured the largest market share first would eventually be able to raise prices and cut costs once weaker competitors were driven out of the market entirely. Regulation added another significant layer of pressure on top of an already fragile model. Several major U.S. cities, including New York and San Francisco, passed laws temporarily capping the commissions delivery apps could charge restaurants during the pandemic, with some limits set as low as 15%, roughly half of what platforms had previously charged in uncapped markets. These caps directly targeted the platform's primary revenue stream extracted from restaurants, forcing companies to lean even more heavily on customer-facing fees just to make up the shortfall. On paper, it looks brilliant. Reality is different, and the difference shows up clearly the moment you look at the actual financial statements these companies are legally required to publish. Restaurants, meanwhile, face their own brutal version of this math from the opposite side of the transaction. A restaurant already operating on thin margins, often in the range of 3 to 9%, according to widely cited industry benchmarks, can see a significant portion of that already thin margin wiped out simply by fulfilling a single order through a delivery app. Many restaurant owners have publicly described feeling trapped inside this system. Refusing to join a delivery platform risks losing visibility and order volume entirely to competitors who did join. But joining means handing over a meaningful slice of already thin profit on every single delivery order that comes through the door. Here's an interesting industry fact most customers never consider while tapping through the app. Delivery apps often make significantly more profit on convenience store and grocery delivery than on traditional restaurant food delivery. Grocery and retail orders tend to have higher average order values and far lower preparation time variability, meaning drivers spend less unpaid time waiting around for food to be cooked, and the platform's margin holds up considerably better per delivery. This is precisely why companies like DoorDash and Uber have aggressively expanded beyond restaurants into grocery, retail, pharmacy, and even alcohol delivery in recent years, chasing categories with fundamentally better underlying unit economics than the restaurant business that originally built their brand. Consider the case of Grubhub, once the dominant player in the U.S. market before losing significant ground to both DoorDash and Uber Eats over the following decade. Despite years of first-mover advantage and early market dominance, Grubhub was eventually sold at a steep loss, acquired by Wonder Group in 2024 for a fraction of what its previous owner, Just Eat Takeaway, had originally paid for it years earlier. Being early and dominant in this industry didn't guarantee lasting profitability. It simply meant absorbing years of accumulated losses before the business model matured enough to survive on its own. Debt and financing tell a similar story throughout this industry's short history. Because delivery platforms burned through enormous amounts of cash for years chasing growth, they relied heavily on venture capital and public stock offerings rather than actual operating profit to fund their expansion. DoorDash's 2020 initial public offering raised billions of dollars, essentially betting that public market investors would tolerate years of continued losses in exchange for future market dominance and eventual profitability down the road. That bet has partially paid off, though not in the way most people originally expected. In more recent years, several major delivery platforms have finally reported profitability, driven not by lowering prices for anyone, but by essentially the opposite, raising delivery fees. Introducing paid subscription models like DoorDash's Dash Pass and Uber One, and shifting meaningfully toward advertising revenue, where restaurants pay extra simply to appear more prominently in app search results. An entirely new and highly profitable revenue stream layered directly on top of the original commission model. This is the real turning point in the industry's underlying economics. Subscriptions create predictable, recurring revenue that doesn't depend on winning a single order-by-order bidding war every night of the week. Advertising revenue, similarly, doesn't require paying a driver a single cent. It's essentially pure margin, closer to how a search engine or social media platform generates money than how a traditional delivery business ever did. Business failures line this industry's short but eventful history. Numerous smaller delivery startups, flush with venture funding during the boom years, collapsed entirely once investor enthusiasm cooled, and companies were suddenly expected to show a realistic path to actual profit rather than growth at any cost, at any price, forever. The future of this industry is shifting toward consolidation and diversification simultaneously. Fewer major players now control most of the market than existed just 5 years ago. Grocery, retail, and advertising revenue increasingly matter more to these companies, bottom line, than the original restaurant delivery model that built their brand recognition in the first place. Some platforms are experimenting heavily with ghost kitchens, restaurant-less kitchens built specifically to fulfill delivery orders efficiently, cutting out the overhead of a traditional dine-in restaurant entirely and optimizing purely for delivery speed and cost. So is this business actually worth owning? The platforms that succeeded are the ones that stopped relying on delivery fees alone and built genuinely diversified revenue, subscriptions, advertising, and higher margin categories like grocery and retail. The ones that failed were the ones that assumed market share alone would eventually convert into profit, without ever fixing the fundamental math of paying a driver more than the order itself was actually worth. The next time your delivery fee seems suspiciously high, remember this: you're not just paying for someone to bring you food to your door. You're funding one of the most complex three-sided marketplaces ever built, one where, for over a decade, almost nobody in the entire chain, not the driver, not the restaurant, and often not even the platform itself, was reliably making money on the transaction happening right in front of you.